Welcome back, everyone. Our next panel is on investigating the increasing demand for fixed income ETFs. Moderating this panel, I'm delighted to say we have Fabrizio Zumbo, Associate Director of European Asset and Wealth Management Research at Cerulli Associates. Over to you, Fabrizio.
Good afternoon, everybody. Thank you very much, Tom. Good afternoon, ladies and gentlemen, and welcome to the ETF stream panel titled Investigating the Increasing Demand for Fixed Income ETF. As Tom mentioned, my name is Fabrizio Zumbo, and I'm the Head of Research for the Asset and Wealth Management Research at Cerulli Associates in London. Today, I'm accompanied by Jason Xavier, Head of EMEA Capital Markets at Franklin Templeton, Irene Bauer, founding partner and CIO at 2020 Investments, and Jordan Sriharan, Head of Managed Portfolio and Passive Services at Conaccord Genuity Wealth Management. The purpose of this session is to give the audience a fresh perspective on the evolution of the fixed income ETF demand in Europe, the main drivers behind the increased demand for such products, the impact of COVID pandemic, and ESG fixed income ETF and the evolution in this segment, but as well the challenges and opportunity in the space. Before starting, I would like to give the opportunity to the panelists to introduce themselves, and then we will continue with the discussion. Please feel free for the audience to send your question to the panelists during the course of the session using the chat box you should have on your screen. We will dedicate the last part of the session to answer them.
Just like to say, Jason is here, but his camera is not currently working. But I promise you, he is here.
Yeah, apologies, I am here.
So welcome everybody, and before starting, as I mentioned, I would like to give panelists the opportunity to just give a brief overview of what do they do and who they are. So Irene, maybe would you like to start?
Yeah, so my name is Irene Bauer. I'm the CIO of 2020 Investments. I create model portfolios for financial advisors, and we also have, for more than 4 years, we now have ESG model portfolios, which is quite good. So we started when really the fixed income ESG ETFs came out so that we could create the multi-asset portfolio. And we also have a fintech arm where we've built a tool that allows you to create your model portfolios or any portfolios much quicker. So it took us several days to construct a portfolio in the past, and now we can do it in several minutes.
That is great. Thank you very much, Irene, for this short introduction. Jordan, do you want to go after? If you don't mind, just give us a brief overview.
Of course, yeah. Sorry. So my name is Jordan Sriharan. I work at Conaccord Genuity Wealth Management, where in the top 10 private wealth managers in the UK, as head of managed portfolio and passive services, and not dissimilar to Irene, we run this profile, actively managed MPS model portfolio products, as well as a passive range equivalent, as well as an ESG as well. So we have a sort of deep history in kind of fund research and selection, and overlay that with our kind of asset allocation responsibilities to build private client wealth portfolios.
That's great. Thanks, Jordan. Jason, do you want to go after?
Yeah, sure. Apologies, I've got issues with my camera. I'm Jason Xavier. I look after the EMEA ETF capital markets team at Franklin Templeton. We're a fairly new entrant into the ETF market in Europe. We effectively have 3 pillars to our range: a multi-factor ETF offering, a passive single country offering, and an active fixed income ETF offering. And it's going to be active fixed income today, I believe.
That's great. Thank you. Thank you very much, Jason. Just to set the scene for the discussion, I would love the audience to know that equity ETF assets grew from 433 billion in 2018 to 550 billion by the end of June 2020. They gather in 2019 43.3 billion from investors in 2019, while they were able to collect equity. I'm talking about equity ETF, 900 million during the first months of 2020. As you know, the coronavirus pandemic hit the stock market, but still fixed income ETF gathered 17 billion of net new flow by the end of June 2020, and their asset stood at 245 billion, up from 162 billion by the end of 2018. So my question is, so we see a quite sustained growth in fixed income ETF compared to equity ETF. My question for you is, what are the main drivers, in your opinion, of the increase in adoption in fixed income ETF? And maybe Jason, would you like to start?
Yeah, sure. Happy to take this one. So the main drivers behind fixed income. Okay. Well, it's worth taking a step back and obviously acknowledging that ETFs, exchange traded funds, are just a vehicle. They're a wrapper that allow investors to express their or gain their exposures based on their fundamental investment goals and objectives. And obviously, with it just being a wrapper, 9 times out of 10, the majority, or 10 times out of 10, the majority of flows are dictated based on those fundamental views. So if you're talking about, what has driven flows into fixed income or flows into fixed income ETFs, there's one pillar that's obviously the fundamentals. So this year obviously has been a very funny year. We've seen the volatility in February, March, April. And if you take yourself back to that time, we'll all appreciate that, markets were very volatile and there was a sell-off in equities and a sell-off across the board, and investors looking for safe havens and ultimately looking to go into fixed income, and in particular, short-dated fixed income or money markets as an example. As we saw, we have Franklin Templeton, a Euro short maturity ETF. We saw flows into that ETF during that period, where investors were looking to for a safe haven to get something on cash and not necessarily pay for holding cash like you sometimes see in money market funds or even depository custodian accounts, etc. So fundamentals drive flows, and we're seeing fundamentals driving the flows into fixed income. Obviously, there's another strong influence there, and that's the fact that more and more investors are, seeing the benefits, the true benefits of the ETF wrapper, and in particular, the benefits being played out in the fixed income space. And that's around things like the price discovery that the fixed income ETF wrapper gives investors, the intraday liquidity and the benefits around that, the executable transparency. These sort of benefits, these attributes, I believe investors are now starting to sort of realize more and more how they can utilize those in their portfolio and utilize the ETF wrapper to help them benefit their quest for alpha and preserve that quest for alpha.
That's great. Thank you very much, Jason, for this very detailed view on that. Irene, can I ask you what's your view on that?
Yeah, I think I can only agree with Jason. So market is, of course, one thing, and we've seen that in March, for example, people piled into fixed income. Then we saw a little bit going out again. But so, yeah, depending on how the markets go, we could see much more flow. I think the other thing is, if we just look at the overall fixed income market, it's more than 120 trillion. And fixed income ETFs are 1.3 trillion. So we are about 1% now. And so I think that's just the natural progression. I think we're still, especially in Europe, so yes, it's a bit further, but not quite as much in fixed income. So we're just at its infancy, really, with fixed income ETFs. And I think that's one of the things, that there's just a general adoption, and that will come. And I think another thing I sometimes heard is that fixed income, yeah, it's much better to go into active because it's easier to outperform. I haven't really quite seen that evidence. We've seen the evidence for equity markets that it's quite hard to outperform. And depending on which area you are, it's like 60 to 80 or even closer to 90% that cannot outperform. But So I think there is a perception as well, and maybe that will change too.
Very interesting. Thank you very much for that. Jordan, what's your view on that? Do you agree it's fundamental? Is investor understanding a little bit more about fixed income ETF and the benefits of this wrapper, or what's your view on that? I think you're on mute.
Sorry, is that better? Can you hear me now?
Yeah, we can.
Lovely. Okay, sorry. Yeah, so actually, some of the points that Irene made at the end there, I think were very relevant. I think active manager underperformance versus a benchmark has, I guess, up to now, probably played quite an important role in pushing people in towards more passively driven strategies. And I know Jason at the beginning made a point that the ETFs are the wrappers, but when you're thinking about it from the passive perspective versus the active, if you think about even the idea around using ETFs for credit portfolios, so to speak, that was kind of it was an idea sort of perpetuated post the Great Financial Crisis, the liquidity issues that they foresaw because dealer inventories would be low because of regulations were dictating investment banks couldn't hold as many bonds on their balance sheets as before. I think what people have seen since then is active managers, as Irene mentioned, underperforming the benchmark, perhaps because they're underweight interest rate duration, overweight credit spread duration. And actually, if you think about the last 3 years and the volatility in that, that's really led to underperformance of the benchmark. And I think all of a sudden investors have gone, well, actually, maybe passives are the way forward. And I think there's a second point that's happened this year. And if you think about it in March, I think the Federal Reserve deciding to utilize high yield ETFs within their arsenal of QE was kind of them qualifying ETFs as a legitimate structure within which to invest. And I think if it's good enough for the largest central bank in the world to use, all of a sudden investors around the world are going to say, well, maybe it's okay for me to use. And I think that's an important driver more recently of AUM.
Very, very interesting. And actually thank you very much for that, Jordan. And actually this point of trust and liquidity is something that is coming up in the industry debate quite often. And actually, I mean, worries about fixed income remaining liquid during period of sustained liquidity stress, as I mentioned, has been at the center stage of the industry debate. And as you mentioned, during March 2020, the ETF, the European ETF market experienced almost 22 billion of net outflows, according to Morningstar data. And we had actually some instances of price dislocation among bond ETF at the height of the market volatility of March. But still, talking to many asset managers and ETF issuers, many mentioned that the pandemic has elevated the status of fixed income ETF. As I mentioned, worried about them remaining liquid, maybe could have diminished. Do you agree with that, or what is your view? And I would like maybe Irene to start, if you have a view on that.
Yeah, so I think there aren't real liquidity issues in bond ETFs, not that they would cause a crash or anything. Now, we have seen that the liquidity, and I think the previous panel was talking about it as well, that actually there's now more liquidity in the ETFs than in the bond prices. And that's often why you see a dislocation, because actually the ETF trades, but some of the bonds don't. So you have stale prices in there, and that's can be one reason why you see premium and discount. But in general, I mean, already if we look back to 2008, in the States, they had a US high yield market, high yield bond ETF, and actually it was fine. And yes, its price went down because that's the normal market discovery. And if more people want to sell, then the price will go down. But actually, it was perfectly fine. We have seen it through some of the European credit crisis and also in March. So I think the providers are very clearly checking that there is enough liquidity for the products they have. And if they aren't completely exotic, I wouldn't expect liquidity issues. But definitely with the next crash, expect prices to go down as well. I mean, in something like high yield, of course, in government bonds, they will go up then, most likely.
Yeah, very interesting point. Jordan, what's your view on that? Do you agree with what Irena was saying?
Yeah, sorry. I mean, Irena's absolutely, totally correct in what she's saying. Single line bond trading is a relatively opaque affair, and think about 18% of all credit is traded every day. So the stale pricing is a really kind of real problem. So I think what ETFs do is they provide some transparency over the pricing. Because they're traded each day, and that's something that you don't get. So if you think about March 2020 and we think about the large discounts that some of these ETFs traded at, it just kind of reflected the fact that the markets hadn't come into line with the real values that were going on out there. So I think it's provided a new form of price discovery that didn't exist before, and actually there are legitimate arb strategies out there that are looking to go short the ETF and go long the bond. So they're arbitraging away the pricing differentials, which only adds to the credibility of ETFs as vehicles to invest in.
Yeah, thanks for that. And Jason, just a follow-up question. Jordan mentioned about liquidity, test, transparency, and what's your view on that with regards to the COVID pandemic? Do you agree with Jordan?
Oh, completely. I'm going to struggle to add much value on top of what Jordan and Irene have already said. But what I will say is that, the pandemic and the issues that we saw earlier this year was actually almost like the final test for ETFs in general. If you go back to early 2019, you still had certain commentators out there suggesting that the next major market crash would be as a result of an ETF. Well, guess what? It wasn't. It was the result of a pandemic. So it was it was a good episode for ETFs to be tested, and they came through it tested well and passed the test. So I think the real takeaway, especially for fixed income, is, and Jordan already mentioned it, is that price transparency, that price discovery. And as you go into the next phase of sort of a take up of ETFs, I think you're going to see more and more investors utilizing the ETF vehicle stroke wrapper for those benefits, because you've really taken what is an opaque market, over the counter driven transactional market, and you've put it on an exchange. And that visibility that you've given it now allows my parents, as an example, to get the same trading intelligence intraday about the bond market as my fixed income fund managers sat at Franklin Templeton. Now, what you do with that information is a different question, but the fact that you've democratized that information is what's key here. You have now given everyone the same opportunity, whether they want to buy or sell, they have the same intel, and that is a powerful thing. That the ETF has really, brought that to light for the fixed income space, and it should be no surprise that we're going to hopefully see a lot more growth and a lot more uptake in fixed income ETFs as a result.
Yeah, thank you very much for that, Jason. Very interesting point. Going to another very, very actual, very actual concept, and it's at the center stage of the industry debate, is ESG fixed income ETF. Just to give you a few data, fixed income. So the European ESG ETF assets reached 48.4 billion at the end of from 28.5 billion at the end of 2019. Of course, the bulk of the assets are in equity ESG product, but fixed income ESG ETF gather 11.6 billion in 2019, and in the first 8 months of 2020, we have 14.9 billion of net new flows in the fixed income ESG ETF. So a lot of growth there. Can I ask you, what's your view on the future development of ESG fixed income product And what are the main challenges for asset managers and ETF issuer when approaching product development in this domain? Irene, maybe you want to start?
Okay. So Larry Fink came out recently saying that he wanted a global standard in ESG, and I can only agree with him. And I mean, that came on the back of him starting at the beginning of the year that the company, so BlackRock, is now going all in ESG and specifically also climate change. And I can only agree with that global standard. So to me, that's, I always then hear like, yeah, but isn't it good to have different flavors? Yes, but we would like to have a standard like we have credit ratings. Okay, we have 3 different companies that provide those, but you know what a credit rating means. And in equities, we know, I mean, the index providers have slightly different free float methodologies, but actually we know what it means. And I would like to see the same in ESG. Now, I think it will take a while to get all the different providers and industry bodies together to really come up with one. And then you can have the different flavors, that one has more climate change and so on. I think that would really work. So for me, it's really about, first of all, it's having more granular ESG fixed income ETFs as well. So we've just seen kind of the broadband, let's call it, and I think we'll see much more there. But then it's also about what is the general methodology that is accepted by everybody and that we can then accept if it has that stamp on, that is approximately what's in there. So I've already seen in equity ETFs, we have the ones that are close to the underlying benchmark index. I call those ESG light because I then hear, yeah, but there's Facebook in it. Yeah, I know, but you have to look at the methodology, what they mean. But actually, I can't see that from the name of the ETF. And I think that's where the industry is making a mistake. We should be very clear what is real ESG and what is kind of just a tilt to ESG, and then also what it means.
Thanks, Irene. A very interesting point. Jason, what do you think about it? It's a matter of standardization, or what's your view on that?
Well, I think there's no question that the ESG and the momentum behind ESG is certainly here to stay. I think for any of us or any of the audience that were trading in sort of 2007, you know, the ESG and the climate change topic came up, and there are a few investment products that were pushed out there, but the GFC sort of put a stop to that, and it didn't go anywhere. But it's clear, even with the pandemic, we're still seeing a lot of demand for ESG, and it's certainly here to stay. I think what we've seen so far is definitely more products tilted to the equity space. Apologies for the shameless plug. We are one of the only, we're the first ETF issuer to launch an active green bond ETF. And we took time to analyze and understand why, A, we want to launch a green bond ETF, and B, why it's going to be active. And the justification behind green bond was that, you know, the money that's raised in the issuance of those bonds are directly correlated, a one-for-one mapping to a green or a social or governance project. So you're buying straight into, in its rawest form, ESG. You then asked the question of benchmark versus active, and we leveraged our, you know, Franklin Templeton's active expertise in European fixed income to effectively then say, well, it's a concentrated market. And that's when you need an active manager to really do some sort of security selection to get, you know, the better value names out of a portfolio and move away from the high concentrations that we saw and continue to see in the index products. So if you think about the market and the EU looking to launch north of 225 billion in green bonds over the next 3 to 4 years, I mean, this market is you know, the growth rate there is going to be tremendous, and I think you're going to see more and more products come out into this space, and they're going to be taken up, and I think they'll be very successful, and rightly so, because for the next generation, it's important that we get it right.
Great, thank you very much, Jason. Jordan, do you want to add something else, or you're perfectly in line with what we said?
No, I'm absolutely aligned, and Irene made a very good point. And I think I'll be very brief on this because to do exclusionary in ESG is quite straightforward and relatively easy. To do inclusionary is easy as well. To do impact is actually a bit more difficult, and I think that's Irene's point about what is ESG to who is perhaps the most important question that needs to be asked. And yeah, you find different corporates in indices that you wouldn't expect to, but it's because of the interpretation of what ESG is, and so that and until we ratify that discussion, it's very hard to then to talk about the growth of ESG fixed income, because there isn't really kind of a fundamental framework in place. And just the last bit on green bonds, because definitely an area of growth. I think again, it's the problem is around regulation, and a lot of large corporates have issued green bonds in the market, which actually they're classifying as operational expenditure rather than capital expenditure. So are those corporates using their green bonds to actually fund projects that are green focused, or are they using it, in the normal course of events? So I think until financial regulation and reporting structures become aligned, it's very difficult for ESG to kind of really take off in a sort of passive format, so to speak.
Thank you very much for that. We're approaching the end of the panel, so I just have another last question for you, ladies and gentlemen, and then we received a couple of questions from the audience. So I will read it after this question. It's a very key point here. China-focused fixed income ETF. A number of China-focused fixed income ETF products have been launched recently, and talking to asset managers, ETFs, whereas there's an increasing interest among investors. So the interest is mounting among investors. May I ask you, what's your view on the growth of this specific type of product, and what are the main challenges in product manufacturing? And who wants to start? Maybe Jason?
Yeah, okay. So the growth of China-focused fixed income, again, it's worth taking a step back and just looking at the tailwinds that are pushing this growth. The Chinese bond market is the second largest bond market in the world outside of the US. If you look at the locally dominated issuance that has now gone into the global ag, they represent about 6% of the global ag benchmark. I think in September, Wigby announced that they'll start phasing in a similar fashion to global ag, and it's the expectation that will represent another sort of 6%. So both those indices will have, 6% weighted to Chinese locally denominated bonds. And to give you a comparable, that is the same weight as the UK and Germany. So regardless of whether you're an active or a passive manager, if you're passive, obviously you have to buy that index and you therefore have to buy those bonds. If you're active with a weight of 6% in those indices, you simply just can't ignore it. So you're going to have active managers getting involved in that market. The clear issues, unfortunately, is the fact that the majority of bonds that have been issued are governments or local policy bank bonds, and so the liquidity is skewed to those sectors, and it's really only those two sectors that are represented. So if you want a much more broad exposure to corporates, etc., there's still, in our opinion rather, there's still room for development there before you're going to see something broader in the sort of Chinese bond space, I would say.
That's great. Thank you, Jason. And Jordan, what's your view on the China-focused fixed income ETF market, and what is the future of that?
Sure, yeah, I think there's probably two lines here. So the first is kind of the corporate angle. So I think investors have been accessing Chinese high yield investment grade bonds through their Asian high yield mandates, and then that's been something they've been invested in for some time now. And I think with credit and perhaps with China's up until now more emerging market debt-like quality, I think investors typically would like to have invested through an active manager who can avoid the elephant traps. And so I think I can see sort of Chinese corporate bonds at this point sort of being more of an active manager's play than a passive spot. But obviously, as China become included in indices, as Jason alluded to, I can see how there's a natural evolution on the credit side. On the government bond side, as Jason was talking about, Chinese government bonds are getting a lot more traction now when it comes to asset allocators, and the yield enhancement at 3% on their 10-year over what you get in treasuries, with their kind of robust credit profile, does mean that more and more managers are looking at Chinese bonds within their overall multi-asset portfolios, and I think they will dip their toes in that area through a passive, because it's difficult to generate alpha in government bond passive active strategies. And so I think you could see kind of Chinese government bond passive ETFs doing well, or at least growing in flow wise, but credit at this point, credit opportunities seem slightly more constrained until things evolve there.
Thank you very much. Irene, do you want to add anything else? We have a couple of questions from the audience, but Irene, if you want to add something else on this, please feel free. And then
I think I just agree with Jason and Jordan. I mean, we've seen with the iShares one, that got 4 billion in a bit more than a year. That's, of course, government bonds. And yes, I think it's hard for providers to get the liquidity in the corporate bonds, high yield, even harder. I was just thinking, because we've just heard that the Ant IPO has been cancelled or postponed. We don't know yet. So I was thinking, is there any scare that there could be more regulatory issues with China than with any other country? And I think that as a provider, you would have to factor that in as well.
Very interesting point. Thank you very much. Very insightful discussion. Thank you, everybody. I just received a couple of questions for the audience, and I wanted to ask this question to the three panelists, if you agree. So the first question is, what fixed income ETF would the investors like to see come to the market? Who wants to start?
I'm happy to.
Please.
Sure.
Excellent.
I think what I would like to see is an opportunity to pick out which parts of the credit rating market you want to allocate to, and what points on the curve. So I appreciate that's kind of easier than done because of the way you have to build ETFs, but we often think about, can we take positions in high credit quality bonds, with a low duration if you want to be defensive, and vice versa. So I think it's one thing we wouldn't mind saying is, could you get low duration defensive sector corporate ETFs, and by that I mean kind of pharma or pharmaceuticals, utility businesses, and conversely, if we want to be risk on, could we buy short duration cyclical corporate ETFs? So banks and industrial names, and it's just that kind of being able to be nuanced in your positioning in credit depending on your risk attitude would be kind of a useful kind of development.
Thank you very much for that, Jordan. And Jason, do you have a view on that? What fixed income ETF would the investor like to see come to the market?
Well, based on what Jordan's just said, Jordan, I think we should take it offline and have a conversation. But no, I think to what Jordan said, I think as we are still in, let's say, fixed income ETF one, series one, let's say, I think as with the equity space, you saw market cap ETFs be launched. You saw then how that evolved into alternative index products, et cetera, et cetera. So I think that it's only a matter of time before issuers start looking for those kind of opportunities, be they alternative indexing, be it GDP weighted, alternative weighted, or as Jordan mentioned, a subsector of particular strategy or play. So I think it is a matter of time before, and as the ETF, the fixed income ETF landscape evolves, I do think we'll see more and more of those products come out there. I don't have a particular product at the top of my head that I would potentially launch, or we would be launching, so I can't give you a direct answer there. But I think there is definitely ample room for evolution.
That's great. Thank you very much, Jason. And Irene, what's your view on that, if I may ask?
I completely agree with Jason and Jordan. So yes, we'd like to see more granularity. I'd also like to see more granularity in ESG. So that's where we're at the first stage, really. And then, similar to what Jason was saying, I think it would be good to also have, for example, technology. So we've seen lately, I mean, in equities, we have all these different themes, and I know you couldn't have those fine granular themes in fixed income corporate bonds, but maybe a general technology would be possible.
Yeah, great point. Thank you for that. And we are approaching the end of the panel. I just have another question from the audience. It with regards to index concentration in fixed income in ETFs. So the audience is asking: we have observed a high concentration of fixed income ETF indexes. Do you think this situation is changing, and what are the consequences of this scenario? Who wants to answer?
So just to be clear, is that a high concentration within the indices in terms of the underlyings, or is that a concentration of only a few index providers supplying fixed income benchmarks?
Good point. I would dare to say it's more on the high concentration of the service provider.
Yeah, so I think it's only a matter of time, and I think that as with any market, as a market grows and evolves, and there's more interest and there's more demand, then I think you're going to see more and more index providers come into this space and offer solutions around that. So again, I think it's only a matter of time before, you know, you'll still have the dominant global ags and WGBs, but you will have other indices that are perhaps a little bit more niche, as we discussed, that will be provided by a alternative provider.
Yeah, very interesting. And Irene, your view on that, if I may ask? I think you're on mute.
Sorry. It's kind of in the background then for me, so I haven't paid attention anymore. So we've seen that already in equities, that there are more and more index providers coming along, but it's easier in equities because in the end, you just need, well, you still need a few fundamentals as well to put some of these indices together, like if they go into values and so on. But it's usually harder in fixed income. And I think once we get over that hurdle, we will have more index providers. Also, the prices will come down for an ETF provider to have to pay the index provider. So that should be good for everybody then. And I think, yeah, it's just a matter of time. But of course, then for more exotic high yield and so on, emerging markets, that's still hard to get all the data in the first place for a new index provider. So it will take a bit of time, but it will be getting better, I think.
That's great. Thank you very, very much. Very sorry, very interesting discussion, but the times is up. Tom is knocking at my door. So thank you very much, all the panelists, and a very interesting discussion. I pass it over to you, Tom. Thanks again, and have a lovely day.
Yeah, great stuff, guys. That was really interesting, and thanks Fabrizio for moderating that one as well. Our next one finally coming up is the closing keynote, and that will be from EDHEC and Amundi, focusing on the EDHEC survey results recently.